Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Lagging indicators. Moving averages are, however, for the most part, a lagging indicator. They, as I've just mentioned, they help to confirm momentum of markets. They're a great confirmation tool, and that's why we consider them a trend-following technical approach, and also why we use the term a lagging indicator. Some other indicators that use moving averages that are lagging, besides the moving average, is also the MACD, Moving Average Convergence Divergence, MACD. Most people aren't aware of that, but the MACD indicator is based on components of moving averages. In fact, here's another one for you. Many people use a popular indicator, CCI. The CCI is actually a moving average of one of my favorite indicators, the pivot point. The moving average of the pivot point is a moving average of what the pivot point is. It's the high, the low, and the close of a given time frame divided by 3. And that's the pivot point, or what we define as typical price. In fact, we can even use a moving average of the pivot point. You can use, as I'll show you in a moment, moving averages of other inputs. Most people use the moving average on a simple or a weighted or exponential, and I'll show you the three differences in a second, based on the close. Oftentimes, for you stock traders out there, you hear about the 200-day moving average or the 50-day moving average, or the 100-day moving average, right? And they're based on the close. Well, I like to use different moving average components to help me identify turns in the market as soon as possible. I don't like to be the last guy with the buy signal, all right? I want to be probably closer to the guy that gets first notified rather than the guy that gets last notified, right? As we all do. Early warning signals. And that's what's important. It's a matter of what your parameter settings are, number one, and what you're looking for and the clues that you're looking for to help initiate a change in momentum. If we're bullish, we're looking for obviously a change in a bearish momentum environment. We're looking for that turn, and that's the one key that we all kind of need a little bit of education on. And then once we have that indication, it's a matter of where's our risk and what can we expect to make out of the trade. I like to say, more importantly, what time of the year is it strongest or weakest? Because if we're at a very strong period time of the year, then I may heighten my expectations for what the market move might give me. Does that make sense? If we're in a weak period of time and I get a buy signal, then I may mute my expectations of what I can expect out of the market to deliver me in form of a price move. And that's where I get my expectations of my profits and losses. So, using moving averages, the most simple and most widely used, and the one that I use, is the simple moving average. There's a weighted and there's an exponential. Both the weighted and exponential are more sensitive to price changes. They're a little bit more complicated, but we have, through the use of computers, an easy way of calculating those out. A simple moving average is very simple. We just take the last series of data. If we took the British pound and we added up 136, 136.20, 136.15, the closing basis of, say, the last 10 days, we add up the sum divided by 10, a 10-day moving average, and that is our average for the last 10 periods. So a weighted moving average is an average that has multiplying factors to give different weights to different data points. Generally speaking, a weighted moving average has a higher degree of weight to the most recent price, and as we see, the meaning of the weights decrease arithmetically. Weighted moving average give a greater weight, as I stated, to the more recent price data. It's a little more complicated, needs the aid of a computer, and the formula is, in N day, weighted moving average, N meaning whether it's a 5-day, 10-day, 20-day, 50-day, longer the term you're looking for weighting the more current data, all right? Using N-day weighted moving average, the latest day has weight and you apply what that percent is. The second has N minus 1, etc., down to 0. So N minus 2, 3, 4, if it's a 50-day, N minus 49. So you're giving a higher weight to the more current price. I like to go over what the actual formulas are with people so that they understand exactly what the nature of indicators are. I have found through my years not only of showing professional traders that they're using indicators, the problem is they don't know what the indicator, what the math formula is based on, so therefore they kind of don't have an idea of what to expect out of the indicator. I mean, quite frankly, if I have a moving average, a 50-day moving average, a simple versus a weighted, I would probably want to use a weighted moving average on a 50-day because it's longer term, it's taking more data and compiling that data. But I feel there are better variations of moving averages that can give me closer and more accurate turn signals than those longer-term trend moving averages, especially in this volatile environment. Because let's face it, we're seeing a move. Let's just focus on the British pound today. In the last, for example, 25 trading days, we've seen a move in the pound go from 145 to 167. That is a tremendous point shift move in a very short period of time. Looking at a 50, 100, 200-day moving average, by the time the averages have turned for you, the move's almost over. So we need something that is a little bit more accurate for short-term trading because in this trading environment, whether it's stocks, futures, or Forex, we're seeing excessive volatility in this day and age of trading. End of story. With exponential moving averages, same thing. It's a more complicated, but it uses a multiplier. The formula is the exponential moving average equals the price, the current price, minus the EMA of the previous times the multiplier plus adding the EMA of the previous. So if you're interested in learning more about moving averages or technical tools, I would tell you to further your education in first off understanding what the mathematical formulas are that create these indicators, and you'll have a better chance of understanding what to expect out of your indicator or your moving average. Here are some pros of moving averages and cons. The pros. First off, moving average define average price changes over time, and it smooths out a lot of trading noise, just like I mentioned about volumes. Excellent trend trading tool. It's also used to identifying triggers, entries, support, and resistance targets. It can be used in trading systems, and mainly is, by the way, and one of the reasons is because moving average systems are easy to backtest with products like Genesis or TradeStation, Fidelity, Wealth Lab. There's a myriad of products out there that you can program and backtest, right? The cons of moving averages. Moving averages lag behind markets' price change. They're not effective in choppy, sideways, or erratic markets. They're not effective in discovering price extensions. In other words, tell me today what the potential range might be next month or next week. We have other indicators that do a better job of that, such as pivot point analysis and Fibonacci studies. And they can't predict, moving averages can't predict turning points, as I mentioned, Fibonacci or pivot analysis, only changes in trends.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.